The top monopolistic companies, which are characterized by a wide moat, meaning that they have a large competitive advantage, not just from growth, but also due to the regulated nature of their business or the necessity of it. Throughout this video, I will be using my tool, Market Vision, a tool available together with your Substack paid membership to give you a grasp of their market share and their monopolistic trade score, which I developed myself. So starting off with number 1, Adobe. I'm personally invested in this company, with the largest portfolio allocation at 15.53%, currently down 22%. This is a company which is enduring troubles as a result of AI tools. Investors are concerned whether Adobe can ensure profitability in the face of competition. Right now, everything looks uncertain for this company, but it's still the go-to solution for many businesses, designers, YouTubers, and others. If we take a look at their market share here, we can see that they are at around 5.8% compared to other diversified software companies. Because Adobe isn't only about design, they also own AI tools, document signing tools, a document reading tool called Acrobat, a web development tool called Dreamweaver for designing websites, and so on and so forth. So they are very diversified. If we take a look at their monopolistic trade score, well, a 9.2 out of 10 is really positive. We can see that they have a high gross margin, which means that they have pricing power. An ROIC, so return on invested capital, is at 28%, which means that they get strong returns out of every invested dollar in the company. R&D percentage is just right, 18%. That's why they get a 10 out of 10 score. Not too high, not too little R&D. Free cash flow margin, it means that they have a robust ability to convert revenue into free cash flow, and that signals underlying financial health. We can see that the revenue growth is at 10.63% more than their market average. So really strong company here. So coming off at number 2, we have FICO, a company which is the provider of the FICO score, which is right now in a sell-off after a move from the governmental institution Federal Housing Finance Agency, or the FHFA, which allowed for the use of Vantage score as well as FICO in credit scores. The majority of the revenue comes from their scores business, around half to be exact. The rest comes from their software businesses, which are focused on analytics and business decisioning. Its market share is marked at around 100% and is largely correct. They have little to no competition in their space, because the owners of Vantage Score, Equifax and others, have a very small revenue portion from this source. Let's take a look at their monopolistic trade score, and we can see it's at 9.2 out of 10. Let's take a look at its components. It has a very high gross margin because it's, as I said before, software based, so very little cost of revenue. ROIC, we can see that every single dollar invested creates a lot of returns. We can see 46 cents, really profitable. R&D, well, it's not at the perfect percentage, but 10.24% isn't that bad. It's around correct, so 7 out of 10 is okay. Free cash flow margin, they have excellent cash flow generation from its operations. We can see 53 and almost 53%. Revenue growth versus the industry, well, it's significantly outpacing its peers. We can see by 16 9.66%. So a 9.2 out of 10 score is a positive. And also I have to mention, I don't own this company, but I'm thinking about owning it. At number 3, we have Microsoft. I'm personally invested in this company, with a 2.9% stake of my portfolio in it. This is a heavily diversified business, we all know, from its Office and Windows offerings. It feels like the default operating system by now. The network effects are huge here. Many people use their products, which converts to a large number of information and feedback from their customers, which leads to even better adjusted value creation from Microsoft. It's a win-win situation. They also own a cloud business, similar to AWS and Google Cloud, which is called Microsoft Azure, as well as the Minecraft and Xbox game console. Recurring revenue is also present in their business. In terms of their price, well, they have shot up significantly recently. What is the reason? Well, Microsoft Azure growth surpassed that of AWS by a wide margin, 39%, that is Microsoft Azure growth, versus 17.5% of Amazon Web Services growth. Their market share is shown here at 10.7%. It's a good metric, I think. If we check out their monopolistic trade score, we can see it's at 8.4 out of 10. Let's go over the components. Excellent gross margin. It shows that they have a high profitability from their sales. A very solid ROIC of almost 20% shows that they are efficient at allocating their capital. At 12% of their sales is allocated to R&D spending, so really positive here. Free cash flow margin, well, you can see there, this is a cash generative business machine at 33.4% free cash flow margin. Revenue growth versus the industry, well, they are outpacing the industry by 14.93%, so really excellent. Now we can go on to number 4, which is Duolingo. Its recent, decline in share price could be an interest to some investors. It's an education technology company with a focus on teaching languages in a simple and fun way, with a gamified approach. But they don't only teach a language, they also teach chess, music, and maths. So I think it's reasonable to expect them to expand to other verticals such as history, chemistry, or physics. I'm excited for them. I'm a shareholder of theirs with a 6.45% of my portfolio in this company. I'm currently down 17.5% in them. In terms of their share price, it's usually volatile, and currently it's down around 50% over the past 4 months. So I want to buy even more of them, and I will probably when I switch over to a new brokerage account. In terms of their market share, my tool here shows that it's at around half a percentage point. In terms of their monopolistic trade score, we can see that it's at 7.2 out of 10, so a bit lower than Microsoft and Adobe, but still positive. We can see that it's mostly driven by their gross margin, which is very high, showing excellent pricing power at 72.38%, free cash flow margin at 35.47%, really good cash generative machine, and also their revenue growth versus the industry is outperforming their peers by 39.5%, so really strong performance here. The returns on their invested capital are slightly lower. I think it's also because they have only recently gone into profitability in 2024. So this might be a small number, but don't be worried by it. Their R&D spending is at 32.5% of their total sales. So for them, it's too high in my opinion. It shouldn't be that much. So that might be a bit of a worry for some investors. If we take a look at the next stock, this is Nvidia, the great performer of the stock market, with its wide range of GPU products, which are at the high end of the industry standards. They also make software called CUDA, which is for programming their GPUs, and it's hard to learn from what I've heard. They own the brand and are synonymous with quality. Many people have bought into them, but I wasn't one of them, as I wanted to buy a different company, ASML, as I thought Nvidia was a hype stock. Maybe it is, but as I've seen their business become larger and larger, I thought that they would still exist in the future, but right now it's too expensive in my opinion. If we take a look at their market share, it's at 6.4%, and you can see other rivals right here. So not bad, but could be better of course. And their monopolistic trade score, well, my tool ranked them at 7.2, no, 7, out of 10. Mostly driven by their gross margin, which is very high at 72%, showing an efficient operation, an ROIC of 69%, really strong. I mean, what kind of business generates that sort of returns? And free cash flow margin, really high as well, at 28.8%, really good. In revenue growth versus industry, well, we can see a very low percentage, probably driven by, well, I don't know, some lower revenue, of course. R&D spending, well, a moderate amount, not too much, not too little, but slightly on the lower side, so I would want them to spend a little bit more. But of course, it's up to the management to establish that, because they also need to think of other factors, such as, of course, the returns that will be given from that. So a strong business here. The next one is Google, the hated monopoly, which won the trial recently, ensuring that they don't have to sell their jewel, their crown browser. They are a very diversified business, from the most advanced probably, and already paid for autonomous rights called Waymo, to services such as Google Cloud, YouTube and Android. I own 15.37% of my portfolio in them, with 35.5% of gains. They have a market share of 19%, as found in my app here. But of course, they have strong competition from the likes of Amazon and Apple. Why? Well, because they are also tech giants, very diversified, those businesses as well. So, if we take a look at their monopolistic trade score, we can see it's at 5.8 out of 10. It's mostly driven by their excellent ROIC and R&D spending. R&D spending is at 13%. Okay, for that business. ROIC is at around 20%. So a good return for their business. Gross margin, 59%. A little bit weaker than the previous companies, but still quite good. Their free cash flow margin is a bit on the lower side, of course, well, mostly driven by their capex and investments in their infrastructure. So I wouldn't be worried about that a lot. They are already returning cash to shareholders via buybacks and dividends, which I'm happy to hear about as a shareholder. The revenue growth versus the industry is, well, a bit lagging at -1%. Could be better, but of course, I'm not saying it's something you should be absolutely worried about. So the last company on this list will be ASML, a company which I own, and I have 10.89% of my portfolio in them, with 1.66% in the green. This is a company which has a large percentage of the semiconductor equipment market, at 24.8%, according to my tool. It makes the world's most advanced lithography machines. Those machines are the size of a bus, need 3 fully loaded Boeing 747s for transport, and cost around $400 million each. Think of that, $400 million just for one machine. They are used to print the circuit patterns on pieces of silicon and are critical for companies such as Intel and Nvidia to make their chips. If we take a look at their monopolistic trade score, it's at 5.4 out of 10. It's mostly due to their ROIC and R&D spending, and their gross margin, well, it's slightly lower than the previous companies at 53.6%, but still pretty strong. I mean, it's quite good. They have a lower free cash flow margin than Google, yes, but it's still positive, 4.3%. Could be higher, but of course they are investing back into the business. Revenue growth versus industry. We have to remember that this is a cyclical business, so revenue growth fluctuations could happen, but they are excellent as they have a very hard to copy, business. It, even China, which wants to beat this company, has trouble, even though they have a large amount of government capital backing Chinese companies. They still are 20 years behind ASML, at least 20 years. So, guys, here is a meme about the monopolistic companies. It shows you why investing in them, in my opinion, is better than me. Is better for me. What do you think of this meme? Tell me in the comments. So there we go. We have gone through 7 companies, of which I own some of them. And I invite you to try out my software, Market Vision, free for 30 days with the Substack subscription included. If we take a look, here's my portfolio, so I'm not lying to you. This is all a real account. It's not a practice one, as you can see here. You can see here are my portfolio allocations. And, thanks for watching. This isn't financial advice.